Most businesses look profitable on paper, yet still struggle to pay bills, salaries, or grow without stress. Why does that happen? The answer is often hidden in one powerful number most beginners ignore: free cash flow. In this video, we explain free cash flow in simple terms with practical, real-world examples. Let's understand free cash flow using a simple, real-world business example that most American business owners can relate to. Imagine a small manufacturing business in Texas that makes custom packaging boxes. Over 1 year, the business reports total revenue of $2 million. After paying for raw materials, labor, rent, utilities, marketing, and other operating expenses, the income statement shows an operating profit of $300,000. At this point, many beginners assume the business is doing great, but profit alone does not tell the full story. This is where free cash flow comes in. First, we calculate operating cash flow. Start with operating profit and adjust for non-cash expenses. Suppose depreciation on machines is $50,000. Depreciation reduces profit but does not involve real cash leaving the business, so we add it back. Now we adjust for working capital. Let's say inventory increased by $80,000 because the business stocked more boxes and raw material. Accounts receivable increased by $60,000 because some customers have not paid yet. Accounts payable increased by $30,000 because the business delayed payments to suppliers. The net working capital change is negative $110,000. This means real cash is tied up in daily operations. So now, operating cash flow looks like this. Operating profit of $300,000 plus depreciation of $50,000 minus $110,000 for working capital changes. That leaves $240,000 of operating cash flow. This is the actual cash generated by core operations, not accounting profit. Next comes capital expenditure, which is the money spent to maintain or grow the business assets. Suppose this company bought new cutting machines and upgraded its warehouse equipment for $140,000. This money physically left the business bank account. Free cash flow is calculated by subtracting capital expenditure from operating cash flow. So $240,000 minus $140,000 equals $100,000. That $100,000 is free cash flow. This is the cash the business truly controls after running operations and maintaining assets. This money can be used to repay loans, pay dividends, buy back shares, build emergency reserves, or reinvest for expansion. Even though the profit was $300,000, the real flexible cash is only $100,000. This gap surprises many beginners. Now imagine another scenario. If capital expenditure had been very high, say $250,000, free cash flow would become negative. That does not always mean the business is bad. It could mean the company is investing heavily for future growth. However, if free cash flow stays negative for years without growth results, it becomes a warning sign. This example shows why free cash flow is more powerful than revenue or profit. Revenue shows sales. Profit shows accounting performance. Free cash flow shows survival, flexibility, and decision-making power. Banks look at it before giving loans. Investors use it to value companies. Business owners rely on it to sleep peacefully at night. If you understand this one number clearly, you understand the real financial health of a business. Free cash flow is the purest measure of business financial strength because it shows how much real cash a business keeps after paying for operations and maintaining assets. It is not influenced by accounting tricks, revenue recognition, timing, or paper profits. Free cash flow tells you whether a business can survive without external funding. It shows whether growth is self-funded or debt-dependent. Strong free cash flow means a business can pay salaries on time, clear vendor dues, handle slow months, invest in better systems, and still have money left. Free cash flow reflects operational efficiency because inefficient businesses burn cash even when sales rise. It reveals working capital discipline by showing whether inventory, receivables, and payables are under control. It highlights capital allocation decisions by exposing whether asset spending is productive or wasteful. It measures financial flexibility because cash gives options, while profit only gives confidence. It is harder to manipulate than net income, making it more reliable for investors and lenders. Free cash flow is critical for loan approvals because banks lend against cash, not profits. It supports dividend payments because dividends can only be paid from real cash. It funds share buybacks, expansions, acquisitions, and research without increasing risk. It protects businesses during recessions when revenue drops, but fixed costs remain. It reduces dependence on investors and venture capital. Positive free cash flow allows faster decision-making because approvals are internal, not external. It improves supplier negotiation power through faster payments. It strengthens credit scores by enabling timely debt servicing. It improves valuation multiples because investors pay premiums for cash-generating businesses. It reflects management quality because consistent free cash flow requires discipline. Negative free cash flow is not always bad, but it must be intentional and temporary. Growth investments should eventually convert into higher free cash flow. Long-term negative free cash flow without scale benefits signals structural weakness. High revenue growth with poor free cash flow often indicates aggressive discounting, poor collections, or inventory mismanagement. High profits with low free cash flow often signal heavy capital intensity or weak cash controls. Free cash flow helps compare businesses across industries because it removes accounting noise. It is used in discounted cash flow valuation models because cash defines intrinsic value. It supports sustainability because cash funds maintenance, compliance, and upgrades. It improves crisis readiness by building reserves. It reduces founder stress because cash shortages cause most business failures. Free cash flow encourages long-term thinking because short-term profit chasing can damage cash health. It aligns leadership incentives with business reality. It highlights seasonality patterns clearly. It exposes hidden leaks like excess inventory, slow clients, or overinvestment in assets. It forces smarter budgeting decisions. Ultimately, free cash flow answers one simple question every American business owner should ask. After running my business properly, how much money do I actually control? If that number is growing consistently, the business is healthy. If it is unstable or shrinking, action is required. Understanding free cash flow means understanding truth, control, and long-term success in business finance.